Hey, hi everyone. Welcome to another video in our hedge fund series. So today we are going to discuss about AI and ML models, and we are going to discuss about predictive AI models, and which are used in the hedge fund industry. And we are going to discuss about only the top few ones that are used by the hedge fund industry for prediction of stock prices and option movements, and also for forecasting. So the top. So first, what we will do as a part of this video is we will go through an English version of all these models, which is basic explanation of these complex mathematical models in plain English terms, and then we will go into a detailed version of these same models, where we'll go into more details rather than a plain simple explanation of these models. So first model that we will talk about is linear and logistic regression. So what this particular thing does is it tries to find relationship between two things, like for example the past price and the tomorrow's price. So it tries to find a relationship between those two. Regression is basically you take two parameters and you try to find the relationship between those two parameters, and there is something called as a correlation coefficient. If correlation coefficient is 1, means if one thing goes up, the other will go up. So that's what it is. And linear regression is basically extrapolating the past data to predict the future. And when the correlation coefficient is 1, then basically those two parameters basically have you know same moment, or if one goes up, the other will go up. One goes down, the other will go down. So in these regression models, what we will do is we will look at the relationship between things like past price and tomorrow's price. We will try to see the relationship between these two, and the model, what it does is it looks at the past price and tries to predict the tomorrow's price. And it is basically whether it will go up or down. That's the only prediction. So whether it will go up or down is a prediction, and that's what this model is used for. Okay, so that's a linear and regression logistic regression model. Then we have decision trees and random forest. So decision tree is like a decision tree basically, where you one if you have to take a decision, any decision that may involve an investment decision or a buying decision. You will go through certain small decisions that lead to a big one. Okay. So like if you want to buy a house, right? So then first of all, first thing you'll ask is, where do I need to buy it? So that is a small decision. What is my budget? That is the next small decision. Then how many square yards are you okay to buy? Do you want to buy a pre built one, or you want to build on your own? So these are all small decisions that you'll go through to come up with that major decision, which is the big one. And this is what is a decision tree. So decision tree, what it does is it maps out your small decisions that lead to a big one. And it will have like yes or no flows, where based on a certain flow you will come to a particular decision. That's what a decision tree is. And random forests are a very you know uh, basically decision tree at scale. The decision trees done with a lot of parameters. It's nothing but a random forest with a lot of outcomes and a lot of parameters, is what a random forest is. So yeah, so it's basically asking yes or no questions to arrive at a decision. Many small decisions will lead you to a bigger one, and those small decision trees you will navigate to come to the bigger decision. Okay, this basically, what is the use of this particular model is it tells us whether it's a good time to buy or sell based on conditions. Okay, so example, volume and RSI. So if the RSI is the volume is high, you may say that let's buy it. So that is one decision tree. And if RSI is above 60, let's buy it, or like that. So that sort of decision, small decisions, will lead to a bigger decision basically. And random forest will involve a lot of other parameters, multiple parameters to come to a decision, is what a random forest is. So then we have XGBoost and Light GPM. These are the other AI models for prediction. So this is nothing but a supercharged version of decision trees, the XGBoost and Light GM. But what it does is it's not just a complex version of decision trees with multiple parameters, but it can learn and from its mistakes, so, and improve the predictions. So that's what the specialty of these models are, that they can learn from their mistakes and improve the predictions. So that the models have the learning capability like humans have. They can learn from the mistakes and improve the predictions. And these models, XGBoost and Light GBM, can be used for predicting short-term price movements, or which stock might outperform. Then we have long short-term memory, LSTMs. These are called long and short-term memory. So this is a deep type of deep learning model that remembers patterns over time, like how people notice trends in prices. So this is like more like a technical analysis where people find all these patterns, right? Head and shoulders, inverted head and shoulders, and flags, pendants, and whatnot, cup and handles. So these are all patterns, right? And or a price action, uh, or upward price action or downward price action, so higher highs, higher lows, or lower, so which indicates a upper uptrend. So such these are basically patterns, or candlestick patterns, or also patterns. So these are all patterns. I'm only talking of technical patterns, but patterns could be even a chart patterns also. Like if chart is moving in a certain way, uh, that also could be a pattern, right? So these models, what they'll do is they'll remember these patterns over time, and then based on it will learn what these patterns are doing. And this is what humans also do. Humans also deploy these, and in trading basically we are forecasting and we are predicting, and we use certain patterns to predict, for suppose some pattern could be, which is widely used, is RSI above 60, take a long position, or above 200 EMA, it is a bullish. So these are all patterns, but and these are fundamental patterns. These are also technical patterns. Okay, fundamental patterns could be like, if a particular stock is giving return on equity very high, above 30%, or return on investment is very high, and its growth rate is very high, and its cost consumption is very less, and it has a very good future potential. So that's a pattern. Okay, so these models, the short term memory, are pretty similar to human beings. They do this deep learning, and they remember patterns over time, like how people do. And this is used to predict the future stock prices based on historical trends, like what might happen after 10 days of gains. Okay, so this is used for forecasting or prediction based on historical trends. Then we have CNN, which stands for convolutional neural networks. So what it does is it recognizes images. So here it finds, so you can give a chart to it, and it finds patterns in that chart, and the price movements in the chart. And this is used, like technical patterns like breakouts, double bottoms, all this it can find. So it can look at the chart, and it can find patterns in the chart, like support, resistance, or breakouts it can find in that, double bottoms it can find in that, and based on that it can predict the future, similar to what humans do by reading the charts. The chartists do by reading the charts to predict the future. Then we have something new, which is transformers, and there are different models in this, BERT and FinBERT. So these transformers, what they do is they read financial news or tweets, and tell whether the mood is positive or negative. So the sentiment of the market based on the information or the news. So these models read, and they tell, whether the mood is positive or negative. And if the mood is positive, then the stock will move up. Or the mood is negative, the stock will move down. So market sentiment based on news and information is used to predict the stock movement by using these transformers. Okay, then we have reinforcement learning. So reinforcement learning is This what these models do is they learn by trial and error, like a video game player who gets better with each try. So these AI trading bots learn what works best over time. So they'll do something again and again, like a new trader does something and he learns from his mistakes, then does something and learns from his mistakes, like not to do over trading, and so on, right? Have risk management, have strategies in place. So the model also learns similarly, and it improves by learning from its mistakes, and by doing a trial and error method. This is called as reinforcement learning models. Then we have Arima Sarima AI models. So these models look at the past numbers and predict the next numbers, like sales or stock prices. And so this is all numbers based, certain patterns. Past numbers are looked at and to predict the next numbers. This is good for short term forecasting, like predicting weekly price trends. Okay, then we have support vector machines. So support vector machines is another model we have. And what this does is it draws boundaries to separate things, like drawing a line between a buy and a sell. Okay, so these models could be like great for making directional calls. So it's like having uh, like a 200 EM, and if it goes above, let's buy it, and if it goes below, let's sell it. So some lines are drawn to separate things, and yeah, between a buy and a sell. It's used for making directional calls whether the stock will go up or down. Like if it reaches the support, also you draw support and resistance lines, and if it reaches support, you assume that the price will go up from there, and if it reaches resistance, it will come down from there. So such similar things are done by these models, drawing a boundary to separate things, and taking decisions based on those lines drawn. Ensemble models. So these combine predictions from all many models to make one smarter decision. This increases accuracy by reducing the chances of one model making a mistake. So this is a combinatory model that takes advantages of all the models, try to make the prediction better. All these models, what they basically do is they learn from the past data. So they take the data of price, volume, indicators, news. That's past data they'll trade, and they'll find patterns or trends in that data. Like the patterns could be, for example, when RSI is low, volume is high, prices goes up. Or the pattern could be, when above 200 EMA the price goes up on a daily chart. That sort of patterns it finds, all these models, and then it makes a future guess, a forecast. Like this is a chance for the probability of this particular thing to rise tomorrow. Okay. So all in all, if we see these models, regression is used to predict whether the prices will go up or down. Tree based is, when it will tell you that when to buy or sell, and LSTM will follow the trend or spot reversals in chart. So following the trend or spot reversal can be done by LSTM models. And the transformers, you can read the news and get a sentiment if it's good or bad, and put good buy position, bad sell position. Reinforcement is training a robot to trade smarter with experience. So some real examples of these models are, yeah, in India, predict Nifty option expiry moves using LSTM, long short term memory, or XG boost. That's a real example. In the US, this Finbert, which is a transformer model, is used to analyze Tesla earning calls and predict stock reaction. Okay, so these are all the AI and ML models, and we went through the famous ones. So let's go deeper into these models and understand them in a deeper way also, not only in plain English and easy to understand language. Okay, so yeah, the linear and logistic regression. It is finding the relationship between two parameters and using historical data to predict the future price. So it's a baseline model for price prediction, and what it does is it basically tells predicts next day returns, and binary classification, buy or sell, it gives you. And it's commonly used for forecasting the Nifty, S&P 500, and stock movement. Simple, fast, and interpretable. So these models are random forest and gradient boosting machines. So These predict the stock returns on price direction, so using volume moving averages RSI. So this is looking at the direction of the price, and then predicting the future based on the pricing direction. And certain other parameters like volume moving averages RSI also it uses to do the prediction. And it handles non-linearity and okay, and features importance ranking is also it can handle. And application of this particular models is options volatility forecasting and earning based moves. These models can be used for long-term, short-term memory networks. So LSTMs are deep learning recurrent neural networks, and these are time series forecasting of stock prices or volatility. These are used for. The advantage of these is they capture long-term dependencies and trends in sequential data, and they are used for predicting Nifty 50 movement based on 20-day history, earning cycles, etc. Convolutional neural networks, which is CNN, these do pattern recognition or candlestick images or sequences, and they use they can be combined with long short term memory for price patterns, and then pattern learning, convolutional LSTMs. And they what these do is, from the images they can detect breakouts, or they could detect certain chart patterns like cup and handle, head and shoulders, like that. These things can detect. So convolutional neural networks could do some sort of technical analysis for us, in short. Okay. Then we have transform models. So these models basically predict market sentiment from financial news, tweets, earning transcripts, and yeah. So this is they are able to get the sentiment of the market based on news. So yeah, they basically look at the financial news, tweets, earning transcripts, and information, and to predict the sentiment of the market, and make a decision based on that. So this predict impact of news on stock prices using news flow. Reinforcement learning. So these are optimal trading strategies via simulated environments. Models learn these optimal trading strategies via simulated environments. This could be used for on Indian stocks also. Popular frameworks in these are reinforcement learning models are Tensor Trade, FinRL, and Jim Any Trading. Autoencoders and anomaly detection models. These detect unusual price movements like pump and dump, or very unusual movement from the main. So these are able to detect that option price spikes pre-expiry or before earnings. They can be applied to use for. And bonus is this is used for fraud detection in algorithm trading logs. ARIMA statistical models. These are statistical models. Series modeling. The use of these models is for time series modeling for short-term price forecasts. They're able to predict bank nifty weekly expiry moves. Support vector machines. Classification of bullish and bearish trends can be done by these models. High accuracy in a narrow range bond markets, sideways ITC or SPI. Ensemble and stacked models learning. So combine multiple models like LSTM, GBM, ARIMA for improved predictions. This is a multi-layer forecast engine for high conviction options trades. So these are all the different AI models we have, and you know we learned a plain English version of these models, and also a detailed deep dive of what these models are and what their use are and applications are. Yeah, and these are used in hedge funds also to forecast the prices. And even in a normal trading, we use certain patterns to forecast or do trading. And everybody, when they are doing trading, they are taking some information, processing it, and forecasting something. So here, what AI is doing is AI is helping us to do the same with certain mathematical frameworks and mathematical models. Yeah, that's it for today, guys. Thanks everyone for joining the call. Have a nice day. Bye.